welcome to another edition of Hardman Talks. My name is Mike Foster. I am the property analyst and I cover Palace Capital. So welcome to this event, which is Palace Capital updating on how they are progressing in the market, and they've recently had some results announced. Please look at our research on this company. There are some really interesting dividend growth estimates that have been made public. And we're very happy to be joined by the CEO and founder, Neil Sinclair, and the CFO, Stephen Silvester.
Thank you, Mike, and good afternoon, everybody. If I can turn to the highlights of our year, which we announced a short while ago. We think it's important. These are the areas that we're focusing on. So when the pandemic struck, we decided that one of the critical aspects was rent collection. A moratorium was issued by the government where you couldn't serve statutory demands on companies or get forfeiture proceedings. How are we going to get the rent? And of course, one of our problems was a number of tenants literally emailed us and told us they weren't going to pay. So we had issues at the beginning of April of last year, but we took the bull by the horns. We've got a very strong and management team who called every tenant, over 200 of them, in order to build up a dialogue. And if you build up a dialogue and tenants understand your problems as well as their problems, slowly but surely you get somewhere. So our rent collection in our first quarter ending June of 20 of rent due was 94%. And during the course of the year, we have actually collected 95% of the rent due. This has been a very important aspect going forward. It's going to continue to be because the government have renewed the moratorium until for another 9 months. So it'll be 2 years, which makes life difficult, but we've managed to handle it. We've done deals with the tenants that we needed to do, and of the few that we didn't, we're pretty well going to be there. So in consequence, we're very proud of the fact of our rent collection, 95% collected during the year, and going forward, that's very important for us. Another important factor is what are we going to do as we come out of this pandemic? And what we're looking to do with the sales of Hudson Quarter, I'll talk about in a minute, and the sales that we've got planned of commercial buildings is to reinvest the money. So we have a disposal program underway of £30 million, which we announced in our trading update in April. We've already sold 9.4 million. One building is vacant. One of them is almost vacant, so we haven't lost any income. And it's 9.4 million. One is completed, the other completes next week. So we're a third of the way towards £30 million disposal. Of that 30 million, once they pay the bank back, we'll have about 15 or 16 million pounds, which will be available to us for ultimate reinvestment. Our return in the year has been 1%, slightly less than the benchmark, but of course we've had Hudson Quarter for 2 or 3 years where we've had no return because all our money has been in there. But that's coming out. We're coming out of that now, and that's already starting to perform very well. So Hudson Quarter is our development. We got planning consent in 2015. We have completed the 127 apartments. We've got 39,000 square feet of offices. The position currently is we have 47 apartments sold. We have 3 under offer, which are due to complete before the end of June. And they will complete because people want to take advantage of the stamp duty holiday. Now, the important factor here is that we will get 14.9 million from these sales. And once we receive that money, out of a Barclays Bank facility for the development of 26.5 million, we'll only have 5.9 million left. And we anticipate that that will be cleared before the end of this calendar year, not financial, but calendar year. So that is going particularly well. We have 4,700 feet of offices on a ground floor in one of the resi blocks. We've let that to Knights, the listed law firm. They're fitting out and moving out next week. And as far as the offices are concerned, we've got 34,000 square feet. We've got someone seriously interested in 15,000 feet of it. We're getting inspections all the time. It's a bit slow, but then people are still working from home, so it's obviously going to be a bit slow. But we're confident that HQ, which is the name of our office building, which yesterday got branded a BREEAM Excellent, will be let before the end of the financial year. We've hiked our final dividend to 3p, and we anticipate as a minimum 3p per quarter going forward. So during the year, we expect to pay at least 12p. We've had 31 lease events during the year, which is rent reviews, lease renewals and lettings, which has increased our income by 0.9 million at a 14% premium to estimated rental value placed on the properties by independent valuers. You've probably all been reading about ESG. We've incorporated ESG wholeheartedly. This is all about energy efficiency. We have a chair of our committee here, chaired by a non-exec director. We have a committee internally amongst our executives, and in consequence, we are embracing it because we have to embrace it. One is what investors want, and secondly, there are buildings which won't meet the criteria that you'll need to meet by 2030. And therefore, what we've done is we're either going to sell those, and that's in part of our disposal program, or we might develop them. So, yeah, so this is Hudson Quarter. On the left is one of the resi blocks, on the right is the office building. Very high quality scheme. We spent a lot of money on the landscaping. You'll see a little building on the left there. We got planning consent for that not long ago, and we put power there, Wi-Fi. If you want to work in the courtyard, you can work there on a reasonable day in York. That's gone down very well. When we first done this prepared it, 43 units were exchanged. As I say, there's now 47 units exchanged, of which one is a penthouse unit for which we got 1.2 million, and that person completes next week. We're forecasting an IRR 15%. As the lockdown restrictions have eased, the sales have accelerated. There was a problem 6 months ago, as you know. People were talking about city centre living. Well, people go back to city centres, and up until not that long ago, they were not doing it. But that's definitely picked up as the shops have opened, the restaurants have opened, the entertainment has opened, and hospitality, and in consequence, that is already beginning to quicken. I've spoken to you about our development loan. Our residential sales program is expected to generate probably £30 million of cash after we've paid the debt off, and that will enable us to make acquisitions in the future, which we'll talk about in a minute. I told you about the offices, and I've also told you about our Grade A office building, which has been awarded BREEAM Excellent. So we're regional property investors. We are focusing on office industrial sector. There's a particular recovery in the regional market. All the statistics show that the return to the office is far greater in the north than it is in the south. That happened after the last lockdown. It's happening again. It is not surprising. Two reasons. One is that London, one has to cope with the commute. But the second thing is, as Northerners will always tell you, they are more social people than we are in the south. And in consequence, they like to talk to each other. And what happens? They're returning to the office. And it's probably at least double what it is in London. We've concentrated our office investments in university towns and cities. We're in Newcastle, Leeds, Liverpool, York and Manchester. We're in city centres close to the station. We think that is very important because under the ESG agenda, driving cars to work is going to be discouraged. So we think out-of-town offices will ultimately go out of favour, and whereas public transport, they will be in favour. We are beneficiaries of the government's levelling up agenda. As you've probably read, the Treasury going to Darlington, Infrastructure Bank going to Leeds, Bank of England going to Leeds. There's a lot of government departments moving north. It can only accelerate. Besides government departments, you've got Goldman Sachs last week announced they've taken a chunk of space in Birmingham. We expect that to continue, and we've got the space for them, and we think we're in a really good place. And Savills came out with a report last year that since 2015, 45% of Grade B and Grade C office space has been lost to either student or permitted development, which is residential. And because there's been limited speculative development in these cities, rental values have held up, and there's always been an underlying shortage, which is why the supply-demand dynamic continues to support our centrally located portfolio. So structural changes, the office market, as we expect, particularly where we've got properties, a return to the office post-lockdown. Working from home is an option, but it's not a replacement. Collaboration is absolutely key as far as we're concerned, and vital to increasing productivity. And as we say, as the ESG agenda gathers pace, it is very important to be in town centres. The regional industrial market has continued to be strong. We've acquired our industrial properties mainly through portfolios. We've kept all our industrial properties. They're performing extremely well, and we continue to see income and capital growth for all of them.
I think this is an important slide just to take note of. We've got a chart on the left, which is our share price performance for the last 18 months. And you will see that as a result of COVID, share price fell from what was almost 350p right down to around 170p. And over the last 12 months, it has gradually been climbing back up. And the chart on the right just shows the discount share price to NAV versus the REIT sector. So you can see the REIT sector is actually trading on average around NAV. Palace Capital remains currently around 25% discount. So there's a real opportunity, we believe, to see our discount closed further. And for us, it's about strategy. What are we trying to do to deliver that performance? We've got three key strategic points that we are focused on. Number one, we're looking at selling down the residential apartments at Hudson Quarter, which will deliver £38 million based on the GDV. We've got the office space, which is now completed. BREEAM excellent, letting 34,000 square foot of office space will add almost £1 million of income annually. And then we've got this 30 mil disposal program. All three of these strategic opportunities are key, we believe, in terms of helping us close that discount. And in fact, if we then take the capital and redeploy into the typical kind of assets that we buy, we could generate an additional net rental income of £3 million per year. So hopefully that gives you a sort of a flavour that, you know, we've obviously come out, or we are coming out of the back of COVID, and we've got three key strategic points that we want to deliver over this next 12, 18 months. And that will give us the ability to not only grow our income, but also deliver capital growth. So in terms of our financials, if you've had a chance to see our results or results presentation, you would have seen overall our underlying rental income was £17.2 million, down on last year. That was largely because of some disposals we made during the year. And you'll see also there's a bad debt provision we've made, just under £1 million in the year, which is very conservative. It takes our overall provision against arrears up to £1.3 million. Of that, about £500,000 relates to tenants that have gone into CVAs, like Pizza Express. That money we're not expecting to recover, but the rest is fair game, and we're already starting to recover some of those arrears. So that's a real opportunity again in this financial year to actually improve our results as we can recover some of those arrears provided against. The key number for us is our recurring earnings, or as we call the adjusted profit before tax, £7.5 million for the year, which delivered 16.4 pence per share. We paid out a dividend of 10.5p, so we're well and truly covered, and with the opportunity to grow the dividend further. The table on the right is some summary balance sheet items. So you can see our portfolio value was up over £282 million at year end. We had just under £10 million of cash, and we had drawn £128 million of debt. So overall, our loan to value was at 42% at year end. That's since come down to below 40% as a result of the residential sales we've made since the 31st of March. And you'll see there as well, the EPRA NTA per share, 350p. That's the share price discount related. This slide, which just gives you an indication of valuation. So every 6 months we get our properties valued. as is required. And you can see we've split it between the 2 half years. So you can see the first half, we saw our valuations of our portfolio fall 3.5% on a like-for-like basis. Clearly, COVID had an impact in terms of valuing some of our assets. But more interestingly is the second half of the year, values are down 0.5%, but obviously a lot less than in the first half. And in fact, we'll show you a couple of other slides which really give us some confidence that actually values have already come out of the bottom and are actually starting to increase. In fact, MSCI provided data over the last few months. I think every single sector has seen valuation rises, even the retail sector, which has been under a lot of pressure. So things do seem to be moving in the right direction now. This is the net tangible asset bridging chart, and it shows that at the beginning of the year we had 364 pence per share, and as a result of those revaluation movements, you can see our NTA at the 30th of September was down to 346.9p. And then in the second half of the year, you can see the benefit of the earnings, movements in value of the Hudson Quarter development, and ultimately we're up to just shy of 350p, which is a positive movement for the second half of the year. I probably won't go through any more at this stage. Neil, do you want to summarise where we're at before we take sort of questions?
Yeah, so just very quickly, you can see that our rents are very modest. The important thing is that in the regions, you can see our rents for offices are £16 a foot on average, where London rents are 100 quid, or West End rents, City is 80, Canary Wharf is 60. You go to the regions, you don't just save on rent, you save on rates as well. And of course, staff costs are much lower. In consequence, and there are strong reasons why people are looking to move north at the moment. Just to say that that's our estimated rental value, 31st of March, 20.6 million. It's a bit less now because we've sold Milton Keynes, which was completed in April. So that's running at around about 20.1. The main thing is to let our vacant space. And we hold a meeting every Monday with the team here about letting vacant space. There is no question we've got more inspections of offices than we've seen probably for over a year. So it's all picking up slowly, but it's definitely picking up. So that's how we are releasing our cash. I told you that 30 billion cash from Hudson Quarter. We've got the disposal program, 9.4 million sales already done. It puts us in a very strong cash position. And as Stephen said, it'll add once we've made the acquisitions with the money we raised, we'll increase earnings by £3 million net using an LTV of 35% and a 6% yield. Just very quickly, we have a refurbishment development pipeline. We've got a small one in High Street, Uxbridge. We just got consent. That's on the market for 1.85 million. We think that's too small for us to consider. We're looking at the feasibility of a small scheme in Beaconsfield, which is a very wealthy Buckinghamshire town. Leamington Spa is at 40,000 foot, 2 buildings in the middle of Leamington Spa. We've got an acre and a half there. There is no way that will get to what we call an energy performance certificate of B by 2030. So we are looking there at doing a mixed use development. It wouldn't start, whether we did it, whether we sold it, it wouldn't start before 2024. We're going through the planning process at the moment, and we anticipate that the consent we'll get will be very similar to what we've got in York. Bankhouse Leeds, that's, as far as we're concerned, that's a real success story. A tenant of ours vacated 18 months ago, moved out of 50,000 feet in the building. We've done some limited refurbishment, pending a scheme in 2024, 2025. And out of 55,000 feet, we've only got 10,000 square feet left. As you know, the market's saying, when are people going back to offices? But we have let 22,000 feet since January. So what we've got there at the moment is an income of 620,000 a year. And once we let the last floor, it'll be 820,000 a year. Having paid only £10 million to the building, that's a very good yield, pending what we might do with the building in 3 or 4 years' time. So these are our cash and cash returns. I won't go into too much. This is what we've sold. You see the proceeds, you can see the returns. And the buildings we're selling now are those buildings which will not meet the energy performance certificate in 2030, number one, or they're too small, or we've done enough work on them there's not much more to do, and to generate any additional return will be too difficult. So I won't talk too quickly about this, but this is active asset management, and you can see with Hudson Quarter I've spoken about. Bolton House we acquired for just over 10 million. It's been valued just under 15 million. When we bought it, the rents were like 12, 13 pounds. They're now 18 to 19 pounds. Milton Keynes, when we bought it, Rockwell had 8 months left on their lease. The other tenant had about 2 years. We did a deal with Rockwell, refurbished the buildings and let it to them on a 12-year lease. We then got another probably 14,500 feet in there. We refurbished it and let it to Monier Redland. That's been a real good performer for us. And finally, with retail, Aldi Gosport came in a portfolio we bought 3 years ago. They were paying 247,000 a year. We bought it, 12 years to go. We got them to agree to a 20-year lease, and we upped the rent by 50,000 a year with uplifts. So that's performing extremely well. ESG, I've spoken particularly about that. We are fully engaged with it. We've got an outside consultant who we're relying on to make sure we fully comply and embrace it. So going 2021 and beyond, we've got the disposal strategy. That's very important to us. Sell all the flats at Hudson Quarter, let the office space, cut the LTV, and generate £50 million of firepower that we can invest over the next 1 to 2 years in acquisitions. We love buying companies. That's what we've done in the past and saved over 10 million in stamp duty. We intend to continue to do that once we've got these disposals out of the way. We're very confident with our regional strategy. The government are looking in the regions, as you know. We see 25% income reversion in our portfolio. We're forecasting a profit on Hudson Quarter of 8.5 million, but that's over and above what we paid for it. We paid 3.8 in 2013. So we expect the total profit on cost to be in the region of 18 million pounds. So we have the regional expertise. We've got a really good network in the regions, a well-established platform. We intend to capitalize on the government levelling up agenda, and we're very confident about the future. And it looks like the market is as well. Our share price has moved quite considerably in the last few months.
Thank you very much indeed for that presentation to you both. And we have got some questions in. Just from my point of view, I mean, it was pretty clear what you've given us in terms of the guide for the current year. I mean, the Hardman estimates 2 years out are for your dividend getting back up to 18p. That's a Hardman estimate. And that is based on, clearly as it's a REIT, a more than fully covered dividend, but it's based on no help from the market in terms of either rental inflation net or indeed from any material reduction in voids, which we do expect to be happening, apart from obviously the letting of the Hudson Quarter offices. But we might come back to that. But just to put it in the context, there is that dividend increase coming through. So the first question actually does relate to the dividend from Alan. It appears that 95% of rents have been collected, but dividends are today 45% below what they were in 2019. What's happened?
Stephen?
Yeah, I think number one, we were paying dividends at a level which was higher than the requirement under the REIT regime. We joined the REIT regime a couple of years ago, and we needed to bring our dividends in line with the REIT requirement. Number one. Number two, it was clear that last year, with COVID having a huge impact across, with landlord-tenant relationships, we clearly needed to focus on our rent collection. But at the time, there was real concern that many tenants across the board would be struggling to pay their rent. There was a moratorium. We had no way of accessing those rents, and even very well capitalised tenants were refusing to pay rent. So back in April last year, we cancelled that quarterly dividend and focused on cash retention, managing through the crisis, making sure that we had sufficient cash for working capital. And then things improved. We had good rent collection stats through the summer. So by the time we came round to our year-end results last year, in August, we paid a final dividend We brought it down to a cash sustainable level that we felt we could continue to pay over this financial year, despite obviously the challenges of COVID. And to be perfectly honest, we are keen to grow that dividend further, but it's contingent really on, as we've sort of outlined in the presentation, it's contingent on us delivering those sales of Hudson Quarter and then being, reinvesting those funds. That will then generate further income that we can pay dividends from.
Most of the questions look at the future, but just one more on the past, which is LTVs and loan covenants. So looking at the past, how near were you, and perhaps with particular reference to the leisure assets, but how near were you to having to have difficult discussions with banks on any individual properties on covenants?
Yes, we've actually, if you have a chance to have a look at this presentation, there is a slide there about covenants. There was a number of, it was particularly focused around the two leisure assets, and that was where those schemes we had to shut. Tenants weren't paying rent for whatever reason. Some of them well-capitalised businesses just refusing to pay rent because there was no teeth for us. Despite a lease agreement, the government tied our hands behind our backs. So interest cover tests were the biggest challenge on those two leisure schemes, and the banks walked through the process with us, gave us covenant waivers, and then as we started agreeing rent payment plans with our tenants, then we were able to demonstrate that we'd returned to good interest cover ratios. There was one test where we had with Scottish widows who lend money to us on the Halifax leisure scheme, and they needed to call for an updated valuation. And as a result of that, we were looking at, well, how do we manage this process? We decided to pay down some of the debt. So we paid down just over £4 million during the year, which then brought our loan to value down. And that's how we've managed our covenants throughout the year. Interestingly, Scottish widows have now said the scheme, that the Broad Street Plaza leisure scheme, has returned to institutional grade on their books, because it's over 90% let. We've let 3 units within the last few months, and that scheme is probably performing as well as it's ever done for us, and that's despite COVID and lockdown. So, huge credit to the asset management team who've worked hard on that asset. But in terms of dealing with the banks, they have been supportive throughout the process, but we're not expecting any further covenant challenges in the future.
Which does actually bring us on to the next question, which is still about leisure, from Gary on broadly, why would there be interest for these leisure assets? What is attractive about the leisure assets, and also very roughly what the sort of loan to values are actually at the moment on those two leisure assets. And just to remind participants, these aren't leisure assets dotted here and there and everywhere. They're two very focused destination venues. So why would they be of interest, and very roughly what LTVs are out there on those two at the moment?
So Stephen will comment on the LTV, but the position is Broad Street Plaza, Halifax. I went there last September, and I remember we had 3 CVAs, as Stephen had mentioned before, and we had a unit that had been vacant since 2012. And it all looked pretty bleak, with the way things were, fact of life. But we've got a strong team here who know what agents to choose and how to deal with these things. And it was critical for us to let these restaurant units. Now, the disadvantage of CVAs is the tenant gives you the keys back and off he goes, or she goes. The good thing is they leave you with a fitted restaurant. So this is common all over the country. So we had 3 units that were fitted. So in consequence, potential tenants didn't have huge capital expenditure in order to open a restaurant, whatever they're going to do there. So that's one of the distinct advantages. Broad Street Plaza is a destination anyway. So we had 3 units to let. We've let 2 of those 3. The third, the Pizza Express unit, is due to sign any day now. We have another unit in a stretch of the scheme, which is not leisure. We've got an NHS in Calderdale, which is in our scheme. We let a vacant area next door about 2 years ago to White Cross Dental, who are part of Carlisle, and they're doing amazingly well. And next to that, there was a vacant unit and been vacant since 2012. We've let that to the government on a 5-year lease. So we've let that space. So we've only got a very small unit left in Halifax, assuming this deal goes through, and it could be virtually fully let. So in Northampton, Northampton, we've spent just under £1 million refurbishing the common areas, making it far more attractive to people to come there. We've got Aqua already there. We've got View Cinema already there. And last year we did a letting to Gravity, who've just taken the big Debenham store in Wandsworth, 80,000 feet, for crazy golf and trampolining and rock climbing and all that stuff. And we've got them in our scheme. And they had a break clause in 2029. And by giving them 9 months at half rent during the pandemic, they've dropped the break clause. So we've got them through to 2034. They've got about 12 to 14 units all over the country. They attract a lot of people. And we've just let one unit to a pizza operator in this scheme. Last week, we agreed to let the least prominent unit in the whole of the development to a health group. And we've agreed to let that. So we're hoping that both Halifax and Northampton will be fully let by the end of our financial year.
I think the question around loan to value, both leisure schemes are loan to value is around 45 to 50%.
And I think it was in the presentation, the average lease length is is over 10 years. So
yeah,
you get that good income stream. A question from Alice about the York Hudson Quarter. You said that there's 15,000 feet of office where there's serious interest.
Yes.
Is part of the whole thing a negotiation on pricing, and how are you pricing up these assets compared to the local market? So it's
right. So York is often compared to Leeds. It's 20 minutes on the train, and it's compared to Leeds. We think it's slightly different. Leeds is a market. York is a market on its own. It had a bit of an office market, but a lot of the office space has been converted to residential. So in consequence, you've got a critical shortage of space in York. And if you want to be in York and you want to be in a new building, there's only one building to go to. There is nothing else. Fact of life. Now, this tenant we're talking to, they're not arguing about the rent, right? That's not an argument. It's not an argument because we're talking £25 a foot or thereabout. They're looking at 15,000 feet. They get £1 a foot off, so what? It's only 15,000 a year. Staff costs 40, 50,000 a year. It's pretty irrelevant. I've learned that in office agency when I did it. That's not the issue. So the only issue we're discussing with them is lease term, break clause, rent free. And we had an issue with this tenant about covenant. We weren't sure about them. They were doing incredibly well until COVID struck. They're coming back, but they've got a very strong parent company. We've met with them. They've seen the building 3 times, and we're in talks, and we're seeing them again next week. It's slow, but we think they want it.
You have nearly 20% of assets tied up in York, and you've got 13% voids. So is the portfolio income stream going to be potentially negatively impacted by a combination of voids on assets that you will be developing and voids on assets that you are in the process of developing?
Well, we've got no development on at the moment, and we don't anticipate any development starting before 2024. That's number one. As far as voids are concerned, we've got interest in a lot of our buildings now. Some of them interested in buildings where we've had very little interest, but it's definitely picked up. What we look to do is you've got to move the dial. So where is our significant vacant space? We've got 20,000 feet in Newcastle. We just finished refurbishing it. That's important. The important thing about letting vacant spaces is this, that Newcastle rents on our sort of space is about £24 a foot, something like that. So you're talking nearly £500,000 a year. And if we manage to do a letting, the great thing is you no longer pay the empty rates on it. So you don't only get the income, you save on the empty rates. It's a double whammy, really. So it's quite important to let the vacant space. So we look at our significant holdings. So we've got significant space in Manchester, we've got 25,000 feet, we've got 20,000 feet in Newcastle. We've got some vacant space in Seoul, Northampton, but we're getting more interest in that. And then we've got floors dotted elsewhere where we've got interest. And slowly but surely, my view is that's all going to get let up. Our void at the end of the year was magnified because Milton Keynes was included, but we sold that, and that was nearly 50,000 feet, virtually all vacant, and we've sold that. That's off the equation. So we've always focused, right, on dealing with our vacant space, and the only way you can deal with it is either let it or, in certain circumstances, sell it. One of the two, and that's what we look at. But we see that steadily reducing. Our target is 90%. That's our target, because you've always got 10% where you've got to do refurbishment work and all that sort of stuff. Yeah. So that's our target, and that's what we're working towards.
Yeah, and just as I said, for listeners, the Hardman estimate is for 18p dividend a couple of years out, and that is based on voids falling by a couple of percentage points, and not much help at all on rents from the market, but clearly letting the Hudson Quarter offices. I've got a couple of more questions. One is from Mike, which is me, in fact. So I'm interested in thinking through in the Manchester, and you mentioned Newcastle and perhaps Liverpool as well. What on the offices? What sort of rental levels are the potential tenants paying for sort of shiny new grade A, and how shiny new is your asset? So are they negotiating about price, that they want something that's kind of 3/4 of the price of shiny new stuff in Manchester? What is their motivation to go to you?
Okay, so let's look at Newcastle. So prime office space that is a prime development at the moment, brand new, is getting about £27.50, £28 a square foot, right? And we believe that we're going to get around £23.50, £24, which is less. The advantage we've got over them, and this is which is very important, is they're a 10-minute walk to the station from their scheme. We're a 3-minute walk, and that's a big difference. And I've learned when I was in office agency, right, when you look at these things, you have to imagine a lady in heels on a January evening, right, when it's raining and it's cold. Do they want to walk 10 minutes to the station? Not really. I mean, that's a fact of life. And I look back at all the things we dealt with over the years. You've got to be near public transport. I mean, it's just critical. And the reason that other building is let, well, is there's been nothing else. So if you want shiny space, there is nothing else in Newcastle. It was the only speculative office development built by the Legal and General. That's it. So in consequence, if you want that, fine, but you've got a 10-minute walk to the station. That is a fact of life. We're 3 minutes walk. Our building was built in 2006, not like it's an old building, and we've refurbished it. So it's not far off what they've got. Not quite, but not far off. So you look at Manchester. Now, Manchester's different. We're looking to do something on that building in about 5 years' time. And we've got a building built in the 70s. So there's people in Manchester who want all the shiny space, and they've got to pay £36, £37 a foot for it. But there's a lot of companies who can't afford £36, £37 a foot, and they want space a bit down the line. So we've refurbished our space to a particular standard. We're 3 minutes from the station. So if you want to be 3 minutes from the station and pay £18, you'll go to our building. If you want everything nice and shiny, you'll pay 37 because you're willing to do so. So there's always a two-tier market, there always is, right? And it's the same in Liverpool. And Liverpool's slightly different because there has not been a new development, office development in Liverpool for several years now, because the people have been very worried about whether they can get the rent to get the return. And that is a fact of life. That's beginning to change. There's a potential scheme of about 100,000 feet that we think will actually happen in the middle of Liverpool. But our rents are like 15, 16 pounds a foot. We're in a very nice building called 1 Derby Square. It's bang in the middle of Liverpool, next to the law courts, 2-minute walk from Paradise One shopping centre. It's a really good spot. And do people want to pay £25 a foot? There's a lot of people in Liverpool who don't want to pay that rent. We fill that void.
And your building just on Liverpool is sort of an ESG, EPC sort of.
We're fine.
That's
yeah. So at the moment it's C, and you need to be B by 2030. We will be.
Yeah. So one more question. I'm not sure how much you want to go into detail on this. It's about Leamington Spa and how much capital might be tied up in that. Is it going to be a similar amount of capital as York, with the implication being that's quite a lot?
Yes. So on Leamington Spa, I was there, as I say, I was there 2 or 3 weeks ago. When we get planning consent, right, and we think we will get planning consent, we will make a decision at that time. Do we want to sell the site with planning permission, which we might do? Do we want to syndicate it as to 50% and do a joint scheme, which we could do? Or do we want to do it ourselves? We don't know what size will be in 2024. We don't know that. We've got aspirations to be a particular size, but we don't know that. But we will review it at that time. Now, when we looked at York, right, and we were looking at a possible joint venture, but it was pretty clear that wasn't going to work. So it was either we're going to sell it or we're going to develop it. But we decided as a board that we're not going to go ahead and develop it, right? Because it was much bigger than the size of our company at the time, until we spoke to our top 3 shareholders.
Right.
So I went to see our top 3 shareholders, told them what I wanted to do, showed them all the figures. Quite interestingly, 2 of them said, "Thank you for coming to see us, but you're running the business, and if your board think it's the right thing to do, we're fine with it." And that was that. But the 3rd one said, "Actually, I'd like to go to York and have a look at it," which is quite rare for a shareholder. So we met him at York Station, and we took him to the scheme, which is about a minute away from the station, showed him the scheme, walked him around York. He'd never been to York in his life before. And he finished, and he said, "Right, I'm completely satisfied. Good luck. Let's go and get some dinner." That's what he said. So, off we went, and that's what we did. So we consulted shareholders before we went ahead with it.
Right.
And we think, and we may well do the same in 2024. Might do the same. I think it's quite important. You cannot forget the shareholders own the business. We don't.
Thank you very, very much indeed for your time, Stephen and Neil in particular, both of you. Very interesting story, we think, and do look at our research. Thank you very much for attending. Thanks, guys.
Thank you. All the best.